Welcome. I'm Ruchira, and today we're talking about Motilal Oswal AMC's latest launch, the BSE 1000 Index Fund, which provides exposure to 1,000 of India's top listed companies, covering 94% of the market cap. To help us understand the details, we have with us Pratik Oswal. He's the head of passive funds at Motilal Oswal AMC. Welcome, Pratik.
Hi, Ruchira, and hello, Value Research. Thank you for having me, and I look forward to having a great conversation with all of you. Thank you.
Great to have you here. Now, let's dive into the details of this fund and see if it aligns with our viewers' investment strategies. So, first up, if you could explain the key features and characteristics of the BSE 1000 index and how is it constructed and rebalanced?
Yeah, sure. So, to give some context about why this fund for us is, I think, an important launch from a product perspective. We've launched over 45 funds in the last 4 5 years. And we believe that, what we've learned in the market is that if you look at the customers, we believe that passive is divided into two categories. One category is your pure play passive. If you look at how Vanguard is known for passive. They're known for, say, broad market funds, or sort of your very simple broad market index funds where you're buying the market. Essentially, you're buying the market. And the second category is more to do with selection, active selection. So we believe when someone is looking at buying a gold and silver passive fund, or a commodity, or a mid cap fund, or a small cap fund, or a micro cap fund, or a momentum fund, we believe that those are more active selections where a customer's preferences or biases come in the middle when they're looking at buying or selling certain passive funds. So we believe that if you look at the original definition of passive, that is buying the market. And that's why we believe BSE 1000 is an extremely important index, because it is the most accurate fund that captures market in India today. It captures about 94-95% of India's market cap in a single fund. And yes, thousand stock portfolio does sound a bit intimidating, but essentially you're buying all of India's market cap in a single fund. So this one fund, which is a thousand stock portfolio, will have access to large caps, mid caps, micro caps, and small caps, all four in a single fund. If you look at how these caps are structured, top 100 stocks tend to be large caps in India. Stock number 101 to 250 is mid cap, 250 to 500 is small caps. And this is not an official definition, but the industry calls 500 and below micro caps. So essentially, you are buying a very large, broad index. And we believe that for anyone looking at buying a very simple, broad-based index, we feel this is the broadest and most accurate version of sort of the market. This index is rebalanced twice a year, in June and December. And essentially, it's a market cap weighted index. So the larger companies will get a larger weightage. The smaller companies will get a smaller weightage. The large caps in this fund will be approximately 60% of your portfolio. Large and mid cap will be around 80%. So primarily, even though it sounds like a fund which micro caps, the exposure to micro caps is limited to 6.5%. So it's essentially primarily a large and mid cap fund. So essentially not as risky as what people think of when they think about BSE 1000.
Right. Now, with nearly 94-95% of market cap coverage, how does the index balance liquidity concerns, especially in micro caps, while it's just 6% you mentioned, but still, while ensuring fair representation, how does it balance liquidity concerns?
No, it's a very good question. So if you look at micro caps as a segment, as a standalone, that's where the concerns come. And volumes in micro caps have grown 13 times in the last 5 years. So the volumes have exploded in the micro cap segment. In addition, the size of companies, in the last 5 years, an average micro cap company has grown 6.5 times. So, if you'd invest in a micro cap 5 years ago, on average, you would make about 6.5, 7 times, maybe more, maybe less, depending on how you're investing. But that's the average size of the market cap has increased significantly. And also, if you look at this index, you rightly said that there's about 6.5% exposure to micro caps. So if you have a 5,000 crore fund, which we don't expect to have over the next 1 or 2 years time, the fund will scale up over time. The exposure to micro caps is under, I would say, 300 crores. And we already at Motilal Oswal run a very successful microcap fund, which is close to 2,500 crores. And, our tracking errors, tracking differences are very low. So we're able to manage that very efficiently. This becomes a lot easier because obviously the exposure to microcaps is very small. So we believe that liquidity is not a constraint at all for this fund. We believe that even if this fund grows significantly, say it becomes 10, 15,000 crore, even then, I think the market has enough depth and liquidity for us to improve it. Plus, you also have to consider that the liquidity will go up from here.
Yeah.
So you have to, so in 5 years' time, maybe so today an average size of a microcap company is about 4,500 crore. So the biggest, I would say, people are surprised, when I say that people assume that the microcap means the small companies, 100, 200, 300 crore. But they're shocked when I say that, an average company is 4,500 crore, which are which are relatively large companies. You don't think about these companies as microcaps. So they are large, relatively large companies compared to popular opinion. They have established business models. They have moats. They are growing at much faster rates. So essentially, you are looking at a slightly more developed India than what you did about 5, 6 years back.
All right. Can you explain what prompted the AMC to launch this fund at this particular time? Why now?
Yeah, so I think why now is a very good question. We couldn't have launched this fund 5 years back because we had this. So when we launched the small cap 250 index fund about 5 years back, people have the same questions as how will MOMC manage liquidity? And we've done a good job. It's a fund with super low tracking error. And we believe that the market is now liquid enough for us to provide this sort of a product to our end customers. Our objective is very simple, is to provide market funds to our clients. We have been pioneers in most of our categories. I would say out of the 40, 45 funds we've launched, maybe two-thirds would be industry first funds, and this is also industry first fund. We want to tell investors that the broad market fund today is flawed. By broad market, I mean the default, broad market fund, which is the Nifty 50, is not a very good fund. It's not relevant as per today's times. It only captures 40% of the market. It is very concentrated. So, people today, when they track Nifty 50, it doesn't really capture the broad market. It captures the top 20 companies of India. So if CNBC says that Nifty 50 is up 5%, it doesn't mean that the market is up 5%. It means that the top 20 companies in India are 5%. You're investing 75, 80% of your money in the top 20 stocks. So we believe that the market has broadened. Even the regulator has taken cognizance of this. And if you look at the default benchmark today, it tends to be Nifty 500, which is a 500 stock portfolio. And there is a lot of interest for people into microcap. So the idea is, Sun, is to really give investors access to a segment which is growing. Today the allocation to large caps is 60%. Will go down to say 50% over the next 5, 10 years time, and a lot of growth people can expect from this broader base index than what you would get in Nifty. In terms of a simple comparison, in terms of setting expectations, which is very important, we believe that investors can make up to 1.5%, 2% higher returns with a broader base index like BSE 1000 over traditional indexes like Nifty 50. And guess what? This fund is actually has a low volatility. So the standard deviation of this fund is lower. The risk from a so risk can be defined in many ways, but if you look at volatility, which is the industry default definition of risk, this fund is less risky than Nifty 50, in spite of having small, mid, micro. So high returns, lower risk. I would say more breadth, more geographical, as well as sector diversification. So overall, we believe it's a much better product than what investors could have. The industry today obviously tends to migrate towards Nifty 50 a lot, but we believe that going forward, this may not be as relevant, and which is why we think that this is a much better index.
Right. You mentioned more breadth, more diversification, but with 1,000 stocks, is there a risk of the index becoming too diversified or diluted in terms of return impact?
No, it's a great question. So as per quantitative finance, if you look at Nobel Prize winning research by Harry Markowitz, anything beyond 35 stocks is over diversification. So any mutual fund today, the whole point about investing in mutual funds is to essentially take out stock specific risk. And guess what? A Nifty 50 does have stock specific risk because 20% top 10 stocks are like 55% of your portfolio. So we believe that actually there is no, and there are very popular papers in the US that talk about the fact that there are no additional benefits of over diversification, but there's no additional negatives of over diversification either. So if you look at Vanguard Mutual Fund's largest fund in the world, it's actually not the S&P 500, it's the total market index, which is I think 4,000 stocks plus. So essentially, what we're trying to do is, provide the market. That's the most important thing. We don't think this is over diversified. In fact, we think it's adequately diversified. Why do I say that? Is because you're essentially getting a portfolio which is 60% large caps, 20% small caps, 15% mid caps, 5% small caps, and 5% micro caps. Actually, it's very well diversified. In addition, this fund actually is excellently diversified across industries. Why do I say that? Is because the large caps are mostly financial services, IT. The mid caps are, I think, mining and minerals and something else. Small caps, the top sectors are different. Micro caps, the top sectors are IT, hardware, and so basically, if you look at the top five sectors in each of these caps, they're completely wildly different. So actually, it's very good diversification. We don't believe that, and which is why and also it demonstrated higher returns than what you could make on, say, a Nifty 100, Nifty 50, or a Sensex. So I think it does show that it has high return potential.
Fair enough. So would you say this fund is more suited as a core portfolio holding or a satellite allocation for diversification?
So this is a core portfolio. Definitely, this is not a satellite. It's a portfolio where we think you can invest and forget for 10, 15, 20, 25, 30 years. You don't have to ever sell it. Large caps do well, your fund will do well. Mid caps, small caps do well, your fund will do well. India does very well, your fund will do very well. So overall, I think, what's really interesting about broad market funds like flexi cap, multi cap, these large, mid, small sort of index funds is that you're not really betting on anything. In Nifty 50, you are betting on large caps. In a factor fund, you are betting on momentum. In a small cap fund, you are betting on small caps. In a micro cap, you are betting on micro caps. In a bank index, you are betting on bank. If you're looking at a broad-based market fund, you're not really betting on anything. So the ability to be disappointed is very low. There is no timing involvement when it comes to broad market fund. And in reality, we run India's largest broad market fund, which is the Nifty 500. We have thousands of investors there. And what's really strange about the fund, which is something which we never expected. So we have 45 funds and we get redemptions from all of those funds on a daily basis. But the fund with one of the lowest redemptions, probably the lowest redemption, is the Nifty 500. It's surprisingly pretty sticky money, which is also why we like BSE 1000, is because we believe that the managing investor behavior becomes a lot easier when you're able to offer these really broad-based passive funds where there's no really need to sell at any point in time.
Right. So one last question. What would you say to investors who still believe that active funds can beat broad-based indices like this one?
Yeah, so I completely agree with them. Obviously, active funds have demonstrated superior performance over passive funds in India over the last 5, 10, 15 years. I think the thing is that ability to find the active fund is become harder. So there is a lot of rotation that happens. The top 10 funds, change every year. So there's this thing where everybody wants to invest in the top 5 funds. But guess what? That ranking keeps changing every year. So when it comes to styles, all active managers have a certain style. And there are periods of performance in that style, there's periods of underperformance in the style. So we believe that yes, there is a lot of merit in active management. We believe that the percentage of active managers beating the index has gone down significantly in the last 5 years. But we believe that when I was first in the industry about 5 years back, it's been a very short time, but there was a lot of conversation of active versus passive. Why should I buy active? Why should I buy passive? There was this constant debate, and it wasn't a very good debate, to be honest. Today, there has been a very, very, very healthy acceptance of passive funds. People are now talking about active and passive. Most people I speak to, partners and customers, want to have 20, 30, 40% allocation to passives, the rest in active. So I think this is a very healthy debate. We think that from a core allocation, especially a large cap valuation, passive is something where adoption has gone up significantly. So we believe that investors should have both in a portfolio. And I think if you're able to, I think buy the good active funds and just, invest through good and bad times, you'll make lots of money. So I think that's at least our perspective.
All right, that was a great overview of the BSE 1000 Index Fund. Thank you, Pratik.
Thank you, Ruchira, for having me, and thank you, Value Research. And we look forward to more of this stuff in the future. Thank you.
Thanks to all of you for watching. Don't forget to like, share, and subscribe for more insights into smarter investing. See you next time.